What is the dynamic nature of option Greeks? Have you ever wondered how the price of an option can change so quickly? The answer lies in something called option Greeks. These are mathematical measures that show how different factors affect the price of an option. The main factors include the price of the underlying stock, time until expiration, volatility, and interest rates. The Greeks, delta, gamma, theta, vega, and rho, are not fixed. They change constantly as market conditions shift, making them dynamic. Let's start with delta. Delta indicates how much an option's price will move with a $1 change in the underlying stock. For example, if an option has a delta of 0.5, that means the option price will increase by 50 cents for every $1 increase in the stock price. However, delta itself can change, especially when the stock price moves closer to or farther from the strike price. This is where gamma comes into play. Gamma measures how much delta changes for a $1 move in the stock. A high gamma means delta can change quickly, making the option's price more sensitive to stock movements. Next, we have theta, which represents time decay. This is the rate at which an option loses value as it approaches expiration. Theta is usually negative for option buyers because options lose value over time. However, it is positive for sellers who benefit from this decay. As expiration gets closer, theta's effect grows stronger, so its impact on the option price is not constant. Vega measures how sensitive an option is to changes in implied volatility. When volatility rises, option prices generally increase, and Vega tells you by how much. Vega tends to be highest for options that have more time until expiration and decreases as expiration approaches. Lastly, we have rho, which shows how an option's price reacts to changes in interest rates. For most stock options, rho's effect is relatively small compared to the other Greeks. The dynamic nature of these Greeks means that as the stock price moves, time passes, volatility shifts, or interest rates change, the Greeks themselves adjust. This makes managing an options position an ongoing process. Traders must keep an eye on these changes to understand their risk and potential profit at any moment. In practical terms, this dynamic behavior is why options traders use Greeks to manage risk. For instance, a trader might adjust their position to stay delta neutral, meaning they aim to offset directional risk from stock price movements. They might also monitor gamma to avoid sudden large changes in delta or focus on theta when selling options to benefit from time decay. Understanding how these Greeks interact and change helps traders make informed decisions and adapt their strategies as market conditions evolve. The option chain, which is a table listing all available options for a stock, displays Greeks for each contract. By comparing Greeks across different strikes and expirations, traders can select positions that match their market view and risk tolerance. For example, a trader expecting a big move might look for options with high gamma, while someone seeking steady income might focus on options with high theta. The dynamic nature of option Greeks reflects the ever-changing relationship between an options price and the factors that influence it. Successful options trading requires not just knowing what each Greek represents but also understanding how they interact and evolve with the market. This knowledge allows traders to respond to new information, adjust their positions, and better manage the risks and opportunities that options present.